This is Invested in Climate with Jason Rissman. I see climate as the world's biggest, most diverse, most important movement in human history. Millions of people dedicate themselves every day to protecting the planet. This podcast shares conversations with advocates, entrepreneurs, investors, policy experts, and anyone else that can push our thinking about what's possible and what needs to happen to address climate change. If you have ideas for episodes or feedback, get in touch on LinkedIn. If you enjoy the show, please leave a rating on Apple or Spotify. I'm currently building a new venture. It's related to storytelling and how we engage all sorts of folks in meaningful climate action. If you have expertise in this area, big ideas, or examples of something that's really working, get in touch. Thanks for listening and for doing whatever it is you're doing to support climate progress. Okay, let's get started.
I would encourage people to stay focused on the fact that at the end of the day, driven by AI and data center proliferation, demand for electric power in the U.S. is rapidly and undeniably increasing, and we need to focus on the most efficient ways to meet those increases in demand. And in parallel, we also need to help heavy industry to adopt new technologies that allow them to continue to use less resource and to operate more efficiently.
Hi, everyone. Climate tech companies face a range of structural challenges to securing the mid-stage investment needed to scale their solutions. The lack of capital at this stage prevents many viable, potentially transformative technologies from going mainstream and eliminating gigatons of emissions. That's why we've been running a series of episodes on the missing middle in partnership with Spring Lane Capital. If you haven't heard our previous 3 episodes in this series, check them out on investedinclimate.com. And if you have ideas of other topics that warrant a deep dive series, please reach out through the contact form on our website. For the 4th episode in our series, I'm joined by Spring Lane Capital co-founder and partner Rob Day, who guest hosts this conversation with Blackhorn Ventures managing partner. Rob, thanks for being here and for your partnership on this series. You asked Melissa to join us today. How come? Tell us a bit about why you reached out to Melissa and what you're hoping to learn.
Well, I wanted to interview Melissa because not only do we think Blackthorn as a venture firm are doing some really interesting things and approaching this whole missing middle problem from a different perspective than my firm does. They're much more focused on digital infrastructure and data. We're more focused on the hardware side, but still seeing and diagnosing the same problem and approaching them different ways. So that's going to be interesting to hear about when it comes to Blackthorn. But also Melissa herself has a background much more as a financial generalist, and she has the perspective beyond just venture capital that'll be really interesting to dig into.
Fantastic, Rob. I'm looking forward to this conversation. Let's get it started. Here we go.
Melissa Chong, thank you very much for joining me today, participating in our Missing Middle podcast series. It's really great to have you on. Blackthorn is a really great shop doing some really interesting stuff, some smart approaches to helping the companies deal with the missing middle. That's really the subject here of this podcast series. So really excited to spend some time with you. Thanks for being here today.
Thanks for having me, Rob. I'm excited to be here today.
Yeah, awesome. Before we dive into financing the missing middle in clean tech or whatever label people want for that these days, and discussing all of that impressive work that you guys are doing with founders and companies, and especially how your team gets them to scale in the current market environment. Why don't we start? Just tell me about your path to Blackhorn Ventures. What led you to venture capital from having worked? I know you were in family offices to start.
Yeah, to be totally honest, my path to being an early stage venture investor was neither planned or expected. You know, while I've been working in finance and investing roles for the past 20 years, I started my career in investing roles that were more investment banking and credit oriented, actually. So I started as an investment banking analyst working for Deutsche Bank in New York City and in London, financing private equity LBOs, eventually moving on to credit direct investing roles. You know, all of this obviously being on the complete opposite end of the spectrum from early stage venture. So sitting where I am today in the seat that I sit in was not planned or expected. I was actually working at a special situations hedge fund when I had my own kind of moment where I had like that moment where there was like a calling. And it sounds a little bit contrived or not necessarily, it may sound cheesy, but I feel like for me, when my first son was born, I had my aha moment. I've always looked at investing and the work I was doing as like an opportunity to help solve problems and really help to figure out how to meet an issuer's needs, but at the same time, making sure that as the investor, we were being compensated. So structurally determining like how to solve that problem. And then when my son Quinn was born, I really found myself looking for more meaning. I think in that quest for looking for more purpose, I don't know if you've had that experience yourself or if there was a moment where you were like, what am I doing? Like, I need to be.
Right. Yeah. I'm one of those really dorky people who had that moment in his teenage years, but that says more about me and my own wonkiness than anything.
Well, that's cool. I mean, I think that's cool too. Like you had a North Star and you followed it, but
yeah, not always in a straight path, but yeah. As you've made that kind of transition, I know venture capital is its own beast. What have been sort of the biggest, you mentioned aha moment around sort of the sector and what are you working on, but what have been some of the biggest learnings and things you've had to sort of retrain yourself on to go into venture capital?
Yeah. So there was, again, after Quinn was born, I made a very intentional pivot to working in what was then a very nascent world of impact investing. I was incredibly lucky and just kind of in the right place at the right time when a company called Imprint Capital was building out their team. And in that role, I mean, you're very familiar with Imprint. I know you know John and Taylor and the gang. But we advised families and foundations and financial institutions in structuring and building sustainable investment strategies and portfolios for those families and individuals, really specialized in working across that whole spectrum. So ranging from PRIs or more program-related investments that were concessionary in nature to all the way through to ESG-based public market strategies. And it was a really fascinating time to be an early impact investor. We went from being more of a small upstart investment consultant to eventually being acquired by none other than Goldman Sachs. And just before that acquisition, I personally made the transition to working in-house with a family office as their chief investment officer. So they were a client of mine, had very specific interests in a global, more emerging markets-centric climate mandate. And, I had the opportunity to work with them to be much more thematically focused just on climate and then help that family build out a strategy and the infrastructure that they needed to build out a more multidimensional but climate-centric set of investments across public and market opportunities. So that's where that transition really started for me. And then about 10 years ago, I had the opportunity to work with a family here in Denver, Colorado, a member of the Walton family, to launch a family office platform. Again, climate-focused or centric issues were at the heart of what they wanted to do and what they wanted to focus on. And we got to work on a whole host of really exciting projects, but Blackhorn was one of the 9 early stage managers that we initially placed capital with as an LP. So that's how I originally came to meet the team that I now work with here at Blackhorn. I joined the firm as a general partner in 2019. And at that point in my career, I was really excited to transition to venture because I saw the opportunity to drive industrial scale outcomes through a thesis driven and specialized strategy that my partners and I really believe has the ability to outperform the broader market. So, to be honest, it feels really nice to be a specialist today after being a generalist for so long in my career and sitting kind of higher up at a portfolio level with clients that I was advising and working with.
Yeah, absolutely. And even as a generalist, you got to engage in venture capital, but now being, for the past few years, fully immersed in it, what's been the biggest surprise to you taking it from this seat now?
Again, I came into investing in finance, being kind of drawn to the deal. I like doing deals. I like the art of the deal. I like the structure of the deal. I like working with people to, again, like solve problems and figure out like where that market clearing price is. Because sometimes it's actually surprising how much give and take there can be. But I think with venture, the thing that I've actually enjoyed the most, that's been sort of surprising to me, but maybe not my family and friends, is the whole building of a team. I think for me, I really enjoy and like working with my colleagues and building out recruiting talent and cultivating talent and helping people grow and advance. And that part has ultimately been super rewarding to me. And I think it's probably the thing that I'm the most proud of here is just building kind of what I would describe as like I really believe this is a best-in-class platform focused on seed and Series A investing. And we're dedicated to partnering with those founders to ensure that we can help to be a differentiated partner. So that I think has been the biggest surprise to me is I've moved away from wanting to just focus on doing deals to building a team.
Yeah. And it's so important, to be a successful early stage venture investor like yourself to do all of that value added work and really help the team. So I agree with you. That is the fun part though. Can you give the listeners a bit of an overview? We've talked about your background, but give an overview of Blackhorn and particularly the types of companies that you guys do look to invest in and partner with that.
Yeah. And so for some context, Blackhorn is an early stage venture capital fund or firm. And we were founded by a group of entrepreneurs, investors, and former founders that were aligned around the Industry 4.0 thesis, focusing on the idea that the transformation and decarbonization of industrial sectors really requires rapid and massive adoption of unprecedented levels of digital infrastructure. So in the work we do, we target some of the largest and most critical industries in the economy: energy, the built environment, transportation, and logistics. And we've added manufacturing as a separate standalone vertical more recently, just because we see so much opportunity within industrial automation and looking at this whole movement to reshore and onshore manufacturing creates like massive opportunities for decarbonization and, the adoption of significant amounts of AI and so forth. So these interconnected industries together constitute $3 trillion of annual revenue and serve as the foundation of US and global GDP. The kinds of companies that we focus on and target are capital efficient asset light companies that operate in hard to abate industrial sectors, all with the goal of delivering operational savings or efficiencies and also improvements in labor productivity. So we believe that all of that can be accomplished, but while also generating outsized environmental and social outcomes. And so I think we're a bit different than some of the peers that we will bump into and actually co-invest alongside and partner with within climate tech, in that we don't start with climate being like our initial filter. We would describe ourselves as more of a thesis-driven industrial tech specialist where environmental and social outcomes are really, they're an output of the strategy. So, our team would describe it as taking a bits moving atoms approach to decarbonization, in that our portfolio companies use AI and access to vertically specialized pools of data and enterprise software to scale the deployment of renewable energy, to decarbonize the building stock, to increase the resiliency of our supply chain and manufacturing base, as I just referenced, and then also to increase the penetration of zero emissions vehicles across the transportation landscape.
Very cool. And, I think recent developments over just the past couple of years even have really proven out that digital infrastructure thesis and how important it's going to be this next wave. So I think you guys were a little bit ahead of the curve there. That said, so much about these verticals, these markets, energy, food, water, waste, transportation, ultimately, even a digital solution has to interact with a physical solution. So we continue to see this missing middle, even for those kind of platforms, being an issue, making sure that the physical side of the solution gets the right kind of capital and where it needs to go. Tell us about your firm's approach to that and how you help those companies that you partner with navigate those kind of choppy waters.
For sure. Yeah. And I think sometimes people want to have clear delineation or want us to bucket ourselves as either being software or hardware focused. And I think if you look at our portfolio, there's really a mix of both solutions that are more kind of enterprise SaaS, traditional software, focused and specialized within the portfolio. But then there's also this set of companies where there's for sure a hardware component to the business model. And so I know there's been a lot of discussion around the missing middle and these structural gaps that exist within the climate landscape over the last couple of years. And I think for those that are newer to this conversation and haven't listened to all of your other podcasts, the missing middle is really a gap in that crucial funding, support, enabling environment that's required to scale climate technology solutions, especially in that transition from early market testing to more widespread deployments at scale. And I think, Rob, you and your team at Spring Lane have done a great job of articulating and helping to educate the market around where those structural gaps exist and how we can all kind of work together to find ways to solve the structural problem and source and find non-traditional ways to scale early growth, capital needs for those proven climate technologies. I think for us as early seed and Series A venture investors, we've had a number of portfolio companies that have experienced a wide variety of challenges related to securing that first project finance capital, or whether that be debt or equity. It's hard to find initial capital to prove out a pilot or to just show that technologies can be scaled from an early market validation standpoint. And so I think we are optimistic. I think we believe that while it may take some time and some trial and error and ongoing experimentation, we do think that markets are ultimately efficient. And so we continue to be encouraged by the work that groups like yourselves are doing. But we also think that we have a role to play with working with our portfolio companies and helping those founders explore non-traditional or, again, experimental solutions to addressing how they cross the chasm, for example. So I think crossing the chasm today, given everything that's happening in the world and in the market, can be even more challenging, given that this is an economy where the venture stack specifically was really built for digital innovation rather than hardware advances. That being said, again, while we're primarily software-focused, asset-light investors, we do have that mix of off-the-shelf hardware or resource efficiency-focused technologies within the portfolio. So we're drawn to business models that unlock new markets or that improve or enable the financeability of physical infrastructure assets, such as off-the-shelf solar panels, EV fast charging infrastructure, battery storage, or modular construction materials. We also look for opportunities to leverage vertically specialized pools of data and AI-driven insights, or even workflows to improve the utilization rates with that physical assets are capable of delivering. So all of that enables customers to generate higher rates of return on their investment ultimately.
That makes a lot of sense. And so paraphrasing that a little bit, but you tell me if I'm right or wrong on this, but paraphrasing it a little bit, it sounds like you're saying, hey, one of the things that's happened over the past, couple of decades is that a lot of the physical solutions have been introduced and accepted by the market. Maybe they're not as cost effective as they need to be, but at least they've been accepted. And so figuring out how to leverage the already accepted hardware to drive better economics, better value is one of the areas you guys are keenly interested in.
For sure. I think for us, we like off-the-shelf OEM agnostic hardware opportunities where, the core of the business model serves to really unlock deployment or open up a new customer market or reduce perceived levels of risk on behalf of the investors, whether they be equity focused investors or credit. If there is a way to sort of reduce friction in the system, so to speak, by again, changing the way that risk is assessed. We love opportunities like that. And we think that AI and, again, vertically specialized pools of data that are now being unlocked, that's really exciting to us as a team.
Yeah. So it's almost like using digital solutions to cross the chasm as you described it, right? So for a lot of firms like ours, we tend to think of it as well, how can we help the hardware cross the chasm? And what you're saying is, hey, even when there's hardware, you still need to cross a market chasm. And this is where the kind of digital solutions we're interested in can really help drive that adoption, in much, much faster scale.
Yeah, that's a really interesting way of framing it. And I think that's accurate.
Cool. You mentioned, the vertical pools of data. Can you give a couple of examples as to what that looks like?
Yeah, I think construction is a great, area where there's it's, blue ocean from our perspective, from a unlocking or revealing pools of information that just haven't been accessible previously. I mean, that's an industry where historically workers have been behind desks and haven't had access to in the field data, right? So with the advent of the smartphone and advanced levels of processing power, the ability to track data, which is multimodal, and to then synthesize that, pull that in and pull it together, and then have that be run into the back office, that allows for advanced levels of planning from a design, from a project management standpoint, allows them to eliminate rework and so forth. So I think you'll see a lot of construction tech focused opportunities within our portfolio. We actually just put out a piece looking at the evolving role of AI, again, vertical specialization within the construction tech market and where we think there are opportunities that are particularly exciting for us as investors. And it's an area we will continue to spend a lot of time on. I think for us, again, there's just digital transformation is new to the sector, and there's an eagerness and market readiness for adoption. And I think we've seen that that's like a big piece of it, that sometimes, you might have the right tech and the right team, but if you don't have market readiness from the sector and incumbents as a whole, it's really hard to really implement change, right, from a behavior change point. So commercially go to market can just be much more challenging. Happy to talk about other examples there, because I think we're seeing similar trends right now within energy with utility base and so forth.
Oh, yeah. Well, certainly, I mean, the utility world in the United States in particular is having to deal with a big transition because of AI. You mentioned AI and its usage, but also the AI and its power demand is suddenly turning what was a sleepy electric utility growth story, then turning it into a faster growth story. What opportunities do you guys see for, your style of investing to help on that score?
Yeah, I mean, that's a fascinating example of why is that we've always said for us, there needs to be the right team, the right technology, defensibility within the business model, but also like a hair on fire problem, right? And without that urgency, hard to create that kind of commercial market pool that allows for change and disruption to happen. And I think the issues that you've just alluded to, these unprecedented levels of energy demand or just electricity demand driven by AI and data centers, and the fact that energy pricing is increasing and is only forecasted to continue to increase, it's created urgency. And, there are these big problems to solve, right? Like we need more capacity to be brought online. I think we would all agree on this call that the most efficient and effective way to do that is through solar and battery storage from a cost effectiveness standpoint. There are a whole host of other solutions that can be and need to be brought into the mix from a firm capacity standpoint. But at the same time, there's an aging grid that needs to be able to be interconnected, that needs to be able to handle variations in demand and just change the way that all of this supply is coming online on a more regional and geographically localized basis in connection with data centers and so forth. So again, it looks really messy and it looks really hard, but we see that as an opportunity, because I think we would argue that you need more software, you need more digital technology, you need demand response to be that challenge to continue to be addressed. And what we're also seeing to the urgency or hair on fire problem is that while we have a number of companies that we've invested in and continue to support, dating back as far as 2019, we're now seeing these really interesting inflections happening with utility-focused customers. So that makes us really excited. It makes us more just optimistic around the idea that incumbents, again, see urgency and want to, again, they're proactively taking steps to solve these quote unquote hair on fire problems. So in a time of a lot of volatility in the broader market, I think we're really optimistic. I guess I wouldn't be an early stage seed and Series A venture investor if I didn't really feel, driven by, I didn't bias towards optimism. But, and I do think we are balanced in our assessment of current market risks and so forth. But at the same time, it's really exciting to see that there's this pull happening across different sectors as people move to not only create more resiliency within their existing systems and infrastructure, but there is continued commitment towards.
Yeah, that's really true across sectors, but also that example with the electric utilities in particular is spot on for what we were talking about before, because folks who know that industry know that the biggest obstacle to adoption of more advanced technologies in that sector is the transmission and distribution departments. And for good reason, because their job is to make sure that when you flick the light switch, the lights turn on. So they're very, very risk averse. And I imagine what you guys are finding is that some of the digital infrastructure and other digital based solutions is a way to help them get comfort and stability across an increasingly volatile grid, much less the volatile market conditions you were just talking about.
Yeah, I think a lot of our thinking is also kind of driven with like kind of an anti-fragile mindset right now. If chaos, volatility, continued, inability to predict even like the near term or to midterm future on the federal side of things, it's almost like that actually creates a forcing function or necessitates the adoption of additional digital technology so that asset owners can have more control and can effectively again pivot, adapt, and just be stronger. It's almost like a market hedge to uncertainty right now. And I will say, like, the other thing that I think we get really excited about is it's been a tough market, right? Like milestones have changed for a lot of founders. We're continuing to work through what has been the aftermath of an over exuberant funding market in 2021, and that market correction and reset, continued volatility within the broader market with policy uncertainty, and then now all of it. The cost of capital hasn't gotten any cheaper. So I think it's been cool for us to see certain founders. It's almost like a call to action, like they've risen out of those situations stronger. So it kind of falls within that, like, again, chaos and uncertainty and just making goals harder to achieve. It allows you to just build a stronger organization. And so I think we're seeing that kind of mindset both on the customer side and within our founder base.
Yeah, I mean, it harkens back to, where the industry started, where the sector started. I mean, from an investment standpoint, which was, hey, we're not counting on this to be easy. We're going to work as investors and as entrepreneurs to try to overcome what we know are going to be a bunch of obstacles thrown in our way and be resilient and, like you said, anti-fragile. So yeah, we're seeing a lot of the same kind of return to pragmatism and everything but fusion. But even that, I would argue, is starting to show good signs of pragmatic thinking and leveraging some of these same kind of advancements that you guys are talking about. So if you take a step back from the market chaos, it is still an exciting time to be working in this. One question that popped in my head as we were talking, it isn't something that we talked about addressing, but asking you to put your generalist asset allocator hat back on for a second. We've talked about the forms of capital that might be needed on the project side, on the, startup side. But have you guys taken much of a look, or just you personally taken a look at, new financing instruments? Think about like insurance, unique forms of insurance, things like that, either to address and help project developers, be they startup or what have you, but address the risks of taking on new solutions, or just to create much more of a anti-fragile financial ecosystem around all of these efforts. I mean, are you guys looking at financial innovations in addition to digital stuff? Where does that line blur for you?
Yeah, I just think that, I guess, so that kind of gets to, I think you wanted to talk about like some portfolio company example.
Yeah, exactly.
That kind of gets to that. We can talk through their specific business models that I think really that are we're drawn to, or that we think are particularly interesting.
Great, dig in. Yeah, throw a couple of those in there. It's great to dig in.
Yeah, I think we've not done any work with insurance companies specifically. It's a good prompt. I think it would actually serve us well to have to develop some partnerships there, to look at how we could work with them around some like experimental ways to shift risk or to change the perception around risk with relation to financing certain projects or assets. So that's a great idea. I think it's a great idea, and there's probably some work to be done there. I think what we have focused more on is how to leverage both corporate relationships that we have. We were going to talk about that as well.
Yeah.
I think the role of like corporate strategic investors. I think at Blackhorn, we've always worked with corporate strategics within our LP base. Our LP base is a little bit unique in that we have a mix between kind of traditional family offices, endowments, et cetera, and then corporate strategic investors who, in most cases are investing in the fund because they want access to early stage deal pipeline. They are looking for like an AI partner so they can understand how they can, as organizations, can be implementing AI more effectively. They're looking for M&A targets, which, obviously is like a great thing for us. And they're looking for companies to partner with and pilot within their existing companies. So in some situations, we've seen corporates come in and, I think revenue really, we internally, we always joke and say revenue cures all ills, right? Like it solves all problems and cures all ills when things get really hard. And so whether that's just like simple advanced purchases, like we've had some corporate strategics come in and actually just prepay pilots in full from the beginning, which may sound kind of crazy, but I think if there's been a solution which has been co-developed or kind of customized initially to address specific needs that a corporate strategic investor has been focused on or has dedicated internal resources to, they're more than happy to actually provide the upfront capital to finance all of that capital outlay well in advance. And so we've seen corporates either provide like NRE, they'll book it as CapEx and then essentially absorb a lot of the upfront pilot expense related to product deployment or a pilot. But I think in some ways, like that revenue piece can be more helpful or high impact because it just it helps the company show that they have buy-in and support and market pull from a customer, but then addresses like that kind of gap from a missing middle standpoint that they might experience and having to go out and fund if there's a hardware element to the deal. For example, like we've seen companies do this with relation to prefab home building solutions on the modular side and so forth. So, those are the kinds of things that we've leaned into more, is looking at ways to like leverage corporate partnerships and to show support in ways where there's both like commercial buy-in, but there's the alleviation of like near-term pressure around like capital intensity and capital need to fund a product, either pilot or like the deployment of like a new pilot that a corporate is particularly excited about.
Can you give us a couple of specific examples out of your portfolio where you've, used those kind of innovative finance models and other innovative finance models to help them out? And it's also transparently an invitation to brag about a couple of your portfolio companies, because that's always really fun to hear the specifics.
Awesome. Yeah. I think, okay, so I'll give you two very different examples from our current fund that we're in the process of deploying out of. Formic is a robotics as a service based company. They're OEM agnostic in that they work with a whole host of different suppliers. And, their business model is really based on the idea that they can lease robots to industrial customers on a short-term basis to replace or augment labor. In doing this, they're helping those customers to improve operational efficiency for factories and warehouses. And Formic, as a technology-enabled venture-backed leasing company, is a bit of a hybrid. They look like an IoT-based asset management platform, a SaaS platform, and then in some ways they resemble a fintech company. They're, just to give you a sense of how they generate value and defensibility around the software piece of what they do, the company's asset monitoring and insurance products, which include an uptime guarantee for those underlying customers, that helps to increase customer confidence and reduce system downtime, but also reduces friction to adoption. So it creates the customer pull, but also helps to generate ROI for those underlying customers. But those asset monitoring capabilities also serve to improve the asset bankability of those robotic systems through the monitoring of collateral. So they're like, again, the bits, so to speak, help to make the atoms more valuable or more efficient or more effective. I think their defensive moat from a financing structure standpoint is the fact that they can access these significant levels of leverage that enable for rapid scaling. So at the heart of the fintech part of the company's platform is this forward flow debt facility through which the company acquires robotic systems at a no money down structure at like 8%, with the ability then to go out and lease those systems out at much more attractive margins that ultimately result in like a 60 to 70% asset level EBIT margin. And The cool part about this is they do this by selling these automation service agreements, these ASAs, to a financing partner that then provides the cash value of the total contract upfront, net of interest expenses. So if it is like almost like factoring those contracts to enable them to obtain capital upfront and then scope the implementation and install the robot through an integration partner. So they then collect the revenue once the robot is installed and active, and then they can continue to repurpose those robotic systems through further customer sales cycles, which that, again, only at increasing operating margin. So that's a great example of one that we're really excited about. The business model is for sure pretty complex, but we did this thinking, wow, there are a lot of learnings that could be made possible for other hardware areas where, again, this almost venture-backed leasing model could potentially be applicable to.
Yeah, it's a cool example, not only because it's robotics too, but also a light bulb went off for me when you were describing how the use of the digital infrastructure, the pools of data is used to enhance the quality of collateral and how that unlocks financing. And that's a really interesting insight I never really thought about. But the advancement in all of that additional live data coming off of the collateral is primed to really help equipment financing, asset financing, really step into newer solutions earlier, I think, which is itself going to be really, really important for a lot of these solutions too. But also Formic, cool story because it's also robotics and robots are cool. Can you give me another example of a portfolio company in the that you guys are pretty happy with right now?
Yeah, it's the other example that I would give you is a company called King Energy, which is actually based here in the state of Colorado. This is a great example of how a really smart software solution coupled with strong operational management and a really creative financing model can be combined together to accelerate the deployment of proven technology, in this case, solar. King provides rooftop solar solutions to multi-tenant real estate properties, such as malls and shopping centers. By renting the unutilized rooftops from a property owner, they can then fund the solar development and installation with project financing partners. And then from that point forward, manage all of the ongoing maintenance and billing functions, ensuring ultimately ends up being like a virtually zero cost, hassle-free experience to the underlying property owner. So I think one of the important things to note is that One Bill software billing platform addresses the split incentive challenge that, these, again, multi-tenant C&I have historically, which has prevented multi-tenant C&I from being able to benefit from that solar revolution by allowing energy from a single solar array installation to be seamlessly integrated across and shared across many tenants. Just a really interesting one, we think. I think, and that is just to give you a sense of how the economics work. In that situation, the property owner earns a roughly incremental 1.5% improvement in NOI, and that actually translates to like a 10 to 20% improvement in the overall property value, which is significant. So there's real incentive for that property owner to continue to implement, additional systems with King. And then those underlying individually metered tenants, they benefit from what is roughly a 10% discount in the cost of energy generated by the solar array. So, I think, again, the magic is sort of from a go-to-market standpoint is really unlocked by that fully integrated grid-provided energy piece that then is really like communicated and built out through their One Bill monthly billing summary.
Very cool. And really, it's a smart application of, I think, probably lessons learned from community solar as well, which is sort of a similar kind of approach to, hey, how can we build a big array with multiple customers from that big array? That's very cool. So before we wrap up, this has been a great conversation and really interesting to hear about how you guys are tackling many of the same issues that, like we are so hardware focused ourselves at Springland Capital that we're tackling, but from, much more of the capital efficient and digital side of it. And as we talked about, really helping companies bridge that chasm through those kinds of solutions. But what should listeners take away from this conversation, in your opinion? How do you see venture's role evolving over time to help address this missing middle gap and really help accelerate the deployment of more solutions. If you were to wave your magic wand, and besides what you guys are doing at Blackthorn, but just in general, think about the sector, what should anybody interested in the application of venture capital to impact investing right now be thinking about based upon what you've seen?
Yeah, I think there's no getting around it that the current environment continues to be unpredictable. And there's no doubt that the US climate policy today and the broader landscape continues to look somewhat volatile. I would encourage everyone to stay focused on long-term trends rather than sitting on our hands and doing nothing and waiting. I was just here this morning with one of my partners, Bill Ritter, the former governor of Colorado, who still continues to be, Bill is amazing. He's worked on the state and federal level on the policy side of things, helping bring people across party lines together to focus on energy and climate-focused legislation that really is pragmatic and realistic, but also focused on meeting long-term net zero goals that, I think we'd all like to continue to see ongoing and continued commitments towards. He was his point to me was like, all of these different things that he's involved with on an advisory basis have continued to get postponed. First, it was the election. Then it was the cost of capital continues to be too high. Then, with OBA, while there's been some clarity with relation to tax credits and so forth, like it's really easy just to sit on our hands and continue to do nothing and wait. I just hope that other investors, both at all stages of the spectrum, ranging from early stage and doing what we do today to later stage and even like infrastructure focused investors, which is what Bill was referencing. I would encourage people to stay focused on the fact that at the end of the day, driven by AI and data center proliferation, demand for electric power in the US is rapidly and undeniably increasing. And we need to focus on the most efficient ways to meet those increases in demand. And in parallel, we also need to help heavy industry to adopt new technologies that allow them to continue to use less resource and to operate more efficiently. So I think on both sides, on the demand and supply side, there's a lot of work to be done. And again, I would just encourage everyone to stay focused on those very simple facts from a supply and demand standpoint and not be distracted by all the noise of the market because at the end of the day, it doesn't really change the facts.
Right. Yeah. If you're a long-term investor, which early stage venture investors should be, but also infrastructure investors at the other end of it, if you're a long-term investor, you should focus on the fundamentals. And in many ways, the fundamentals have actually never been stronger despite the volatility in the market. So that makes a lot of sense. Listen, Melissa, this has been a really interesting conversation. Great to hear a little bit more detail about some of the companies, Formic, King Energy. Those sound like really fascinating stories in their own right, but also just to hear a little bit more about Blackthorn. At my shop, our team thinks really highly of Blackthorn, think of you guys as a real leading light amongst energy venture investors and impact investors who get it, who get the challenges and are addressing it in a smart way. So appreciate you taking the time to tell us a little bit more about it and really appreciated it. I really enjoyed the conversation, and really appreciate your time.
Thanks, Rob. Thanks, Jason.
Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.